When it comes to treasury bonds, and I appreciate very many people right now are starting to move money from the money market funds, the unit trusts, to treasury bonds. And yes, in the long run, treasury bonds will make more money than the unit trust, especially if someone learns the compounding game. By the time you as a client builds maybe 10 million, 20 million, later on 200 million in a unit trust, you indeed can build money in the treasury bonds. And it's as simple as this, because also the unit trusts make money in treasury bonds and then they pay us, right? The only difference is with the unit trusts, you just put money there and they do everything else. Here on your side, you make some decision. You have to make decisions which bond to buy, why to buy that bond, when to negotiate it. But if you get those questions right, you will make more money in the treasury bonds than in unit trusts. No doubt whatsoever. Now let's look at the bonds. Let's start with the bonds that are available. And I'm happy when you ask questions about bonds and your first bond is a 10-year bond, there you are good. That's a good move. It might not be the very best, but why? A 10-year bond has a 10% withholding tax. The tax element in the bonds is those bonds that are 10 years and above, they typically have 10%. The bonds that are 20 years, that are 2 years, 3 years, 5 years, those have 20% withholding tax most times. So if you go for a 10-year bond, boom, for me there, I take it as a win, because it means you went for a better bond because of the tax element. But the question then becomes, is it the best bond? Right now, in Uganda, there are two types of 10-year bonds. There is and as you know, there is the 2035 bond that has a coupon rate of 16.25%. Very, very good coupon rate. People love it. There is the 2037. So how we define the treasury bonds, we define them in the year they expire, right? So when you hear me saying 2035, that means that's the year it will mature. When you hear me saying 2037, that's the year it will mature. So the 2037 also has a coupon rate of 16%, and it's also, the coupon rate is it's really good. It's one of the very best right now on the market. However, as you might have noticed, those 10-year bonds have a lower cut-off yield, or what you call a yield to maturity. Many people, when they come to buy treasury bonds, what they think first about is the coupon rate. Until they get, especially people who are buying low amounts, 5 million, 10 million, they might not pay attention so much to the yield to maturity. Why? Because they're like, oh my goodness, I'm getting a bond with 16.25%. It's until they give you how much you are going to pay, you're like, wait a minute, wait, slow down. Why am I paying so much more money than... exactly. So that it's because they have a lower yield to maturity. You could see what the bank gave you was 14.7%. So realistically speaking, your actual profit when you're buying this bond is 14.7%. That's why you want a bond of 200 million and you are going to pay 220 million, another one it's 219 million. So much money that you might not even recover it in the first time they pay the coupon. And that is where, if you don't make that decision correctly, that's where many people later would say, bonds don't make money. It's because they made a good decision, not the optimal decision on when they should purchase. Now, then someone asks, Alex, if I don't buy the 10-year bond, which bonds should I then buy? And it comes so much from a perspective that, you know what, I want to buy a bond, I want to get the best deal possible. And I will always tell them, you go for the 10-year bond, the 15-year bond, the 20-year bond, even the 25-year bond. But there are so many people who will be like, 25 year, I'm not going for the 25 years. I'm 45, I'm 50. You know what? I want to eat my money. What do you mean I buy a 25 year? Do you want me to leave it for the government? Of course. There is a nuance of that, which is, it's bonds. You can sell your bonds, but I understand the dynamics of people not wanting to buy those very long-term bonds. Though for me, I feel okay, someone who can buy a 10-year bond can buy a 20-year bond. Because of the dynamics of the market, that you can sell the bond whenever you want, right? Let's assume in 10 years, you're like, I want to exit this market for whatever reasons, or you just want to go and do something else, you can sell your bond, and sometimes you'll even sell it at a higher price because it would have reduced the years. But let's for now focus back on what is available. So because the 10-year is expensive, then we can go for the 15-year. Now, the 15-year, the current 15-year on the market has a coupon rate of 15.8%. Now, for someone who was willing to buy the 20-year bond at 15, that has a 16% coupon rate, the 15-year bond with 15.8 is not bad, right? Of course, the 10-year bond has a better rate, but 15 is not also bad. However, the current 15-year bond, you can get it at 200 million, right? You pay just an extra 7 million. Now compare that with the 10-year bond where you're going to pay an extra 15, or the other one. Okay, my deal was 15 million, the bank was 19 million, on the other one it was even 22 million, right? So all of a sudden, yes, even this one you're going to pay a little bit of a premium, but it's a premium that you can easily recover, because if I'm to do it for you here, and I'm to compute it for you here, the 15-year bond, when you pay just 7 million extra, the next time it pays a coupon of 14 million. Now, when you look at it from that angle, you're like, you know what, 14 million, it's at least I'm getting back my money that I'm used to buying the bond plus much more. And to me, that's where the optimal decision making is, right? As compared to where you buy a 10-year bond, you pay 15 million, and the next time it pays a coupon, you don't recover it. And that for me is where the decision making is. I've sent it on mail. You look at it for the 15-year bond. So the 15-year bond allows you to pay a less premium. But let's also look at the 20-year bond right now. It's the one which I might even, because it's your first time you're buying a bond, it's the one I would actually suggest for you to buy. And the case for it is one. However much you do not want to buy a bond that is long term, at any one point when you want to sell your bond, you can sell. If your goal is to say, I can hold this bond for at least 6 years, that's all you need to get back your money you have invested. So if you buy a bond of 100 million, in 6 years, you would have got back that 100 million in coupons, even if you don't buy any other bond. Then the rest becomes profit. So for me, that's one. But what is critically important is this. The 20-year bond, you can get it right now at a discount. If you go to the bank, even if you go to the bank right now, and you say, no, I've changed my mind, I want the 20-year bond. And you still do not just sign the paperwork before you engage, because now you have access to your advisor. Like, yeah, send me the details. I look at it and I see if it's a better deal. You could see the other one. I could save a 3 million. That even if I charge you 300, you're like, either way, you're saving a 2.7 million, right? But the 20-year bond will be much better, because for it, right now, the 20-year bond, if I'm to give you perspective on how it is, we can get it at a discount So for 200 million, we can get it at around 196 million. And now that's a lot of, that's already 4 million saved in a discount. But the beauty is not in a discount. The beauty is in, you're not just saving 4 million. You are saving 20 million more, the one you would have paid on the 10-year bond, plus 4 million. So you are saving literally 24 million plus. So ask yourself, which one then becomes better long term? %. Yes. Yes, of course, someone is going to say, yes, why come the 15-year bond, the 20-year bond has a 15% coupon rate, but the 10-year bond has a 16% coupon rate? The coupon rate is not the ultimate decider of when you're buying a bond. It should be the yield to maturity. The 10-year bond, you're going to get it at 14.7 or 15% if you're buying from like Kakande. If you're buying from banks, it's 15.5, 14.5, 14.7, 14.8. Whereas the 20-year bond, if you are getting it from Kakande, you can get it at 15.5, 15.6. If you're buying from the banks, you can get it at 15.2, 15.3. Now, all of a sudden, you see the actual interest rate that determines the profits of treasury bonds is indeed the yield to maturity. And the 20-year bond has a higher yield to maturity that allows you to get even the bond at a price that is less than the bond you are trying to buy. So 17 years, actually 16 years to go now from today. We call it the 20-year bond, but it matures in 2043, which has 16 years to go. So it's a good bond. But even if you don't hold it to maturity, I do not want you to feel like you are obligated to hold this bond to maturity. No, you do not. You can sell these bonds whenever you want. All too, you might even buy a bond today for 200 million. And 5 years down the road, or 2 years down the road, you want some emergency 30 million. You can sell off 30 million. And that's the beauty when we compare treasury bonds to land and everything. One of that is that you can, I don't need to sell all of the bond. I can even just go and I sell 5 million. That's all I want. And they will give me, and the other money, the other 195 will continue making me money. You know? So the 20-year bond has a higher probability to make you more money than the 10-year bond.